Welcome. Today we're going to take a look at financial ratios. But before we do that, if you go down to Disney World and get a job at the Disney company, they're going to talk to you about something called spatial awareness. I have a friend down there, David, that is in HR. And spatial awareness, he always tells me, is being able to grasp the full meaning of all the concepts of your job and being able to perform it well as well. So that's what we're looking for from you guys. If you want to go into accounting, we want you to be able to understand all the aspects of accounting, not just putting financial statements together, but we're really going to start in this chapter to talk about how to run the company based on what we can see. And one of the methods we'll use, and this is in chapter 13, is financial ratio analysis. So we're going to see if we can work a little bit with some ratios today. And there's actually a number of different kinds of ratios. We're going to be concerned mainly with liquidity, which means can we pay our bills. Some ratios tell us about profitability. How profitable is our company? Activity or efficiency. How well are we using our assets? How well are we collecting our money? Leverage. How much risk there is in the company. Who do we owe money to? Do we owe more money than our competitors do? And solvency. What's the odds we're going to be around tomorrow? Those are really good questions, right? So I've shown you on the screen a little bit of page 583, and we're going to take a look specifically at some of these ratios. All of these I think are in the homework, but some of these, the particular ones we're going to look at today are the current ratio and some liquidity ratios, maybe a little bit of efficiency. So I'm going to be switching back and forth between these ratios, and this is problem 13-1A, so I'm going to use that as a little bit of an example. Okay, so the first thing I wanted to show you based on this is the current ratio. Current ratio is current assets divided by current liabilities. So here's the Corbin Company, if you can see it, and here's their current assets, $52,000, current liabilities, $22,000. Normally they're not labeled for you, so you're going to have to pick them out. So things like cash, accounts receivable, inventory, prepaids, those things would be current assets, not plant and equipment, not computers, not buildings, not cars, not trucks, nothing that lasts more than a year. Current liabilities reflects those things that you're going to be paying within the next accounting period, usually a year. So that's accounts payable, taxes payable, interest payable, things like that, wages payable. So to find our current ratio for this particular company, we would divide the current assets by the current liabilities, and it looks like it's a little bit over 2, maybe 2.5 times. That's pretty good. For a small company or medium-sized company, 2 is a really good benchmark. If it's over 2, it's probably pretty good. All right. Let's take a look at another one. Asset test ratio. If we pull out inventories from our current assets, we could actually do an asset test ratio. And this problem doesn't give us a breakdown of the inventory, so we really can't do it. If we would calculate it, an asset test ratio of at least 1 is pretty good. So asset ratios divided by current liabilities at least 1, that would be pretty good. Let's take a look at another one. One they actually don't have here is working capital. Working capital would be current assets minus current liabilities. So that looks like 30 grand. So this company has 30 grand of cash that they can use to create some more profits or keep themselves going or whatever. Okay? That was pretty good. Let's see what another good one might be. Inventory turnover. Let's try that one. Cost of goods sales divided by average inventory. So I'm just going to use round numbers for this particular company. Cost of goods sales divided by average inventory. Let's just look at 2014. So we've got 283,000 in cost of goods sold. Average inventory, and I don't have that. So let's say the average inventory. I guess we'll have to make that one up, huh? Let's say all there is inventory. So if we would add the 30 in the current assets, so if we said that's 37 plus 52, we add them together, we get 89,000. We divide it by 2, it's roughly 45,000. So our inventory turnover would be 283,000 divided by 45,000, roughly 5. Okay? That's not too bad. Let's see. Day sales of inventory. Here's another one. I'll just kind of go through this. Ending inventory divided by cost of goods sold times 365 days. All right. That's pretty good. Solvency, total liabilities divided by total assets. The more liabilities you have, the greater the risk of the company. Okay? And certain industries have a history of higher risks than others. So you want to keep that in mind. Profitability, profit margin ratio, net income divided by total sales. Let's see if we can figure that one out here. Net income, 77,000 for 2014, divided by total sales, 555. Looks like a little over 10%, maybe 12 or 13%. That's pretty good. The average company only makes 3 or 4%. So this is just an introduction to financial ratio analysis. Thanks.